Hello, principles of accounting students. Good morning. Today is Friday. It's a good time to feel good about it. I hope you all doing okay today. Today we are going to talk about chapter 3. Okay, principles of accounting 1, chapter 3, adjusting the accounts. Adjusting the accounts. What does that mean? Adjusting the accounts. I have some coffee here. What does that mean? Now, you note if you please, if you are aware or if you're not aware, uh, sometimes there are some transactions that will affect two accounting periods. Okay, and in compliance with the matching principle, we have to, accountants have to include all revenues and expenses that belong to a specific period. So let's say you signed an insurance policy for 6 months, and you signed this policy on December 1st, 2019, December 1st, 2019, and your fiscal period is from January to December, a calendar year. So you have 1 month, which is the month of December, that have to be reflected from this policy, from this insurance policy, in the current period, and 5 months belong to the other current period, the other next period. So therefore, you have to do an adjusting entry for that month to be included in the financial statements, to be reflected in the financial statements. So that's what I'm saying. You have to to reflect all revenues and expenses that belongs to a specific period. You match revenues against the expenses in the period in which they occur. All right, that is the matching rule. So we have to fulfill that rule. Okay. Now, before we continue, let me just let's just do some review. Remember, we said we got to match revenues against expenses in the period in which they are incurred. Okay, so that's the income statement. The income statement must be reflective of the revenues and expenses in the period, if the period where they occurred. For example, if we have to include, if our reporting period is quarterly, that means every 3 months. That means the income statement must reflect revenues and expenses for those 3 months. Let's just do some review here. Net income is the summary of revenues and expenses and the difference between them. And net income usually increases the owner's equity. Remember, we have to do net income statement first before we do a statement of owner's equity. You remember the formula that we talked about? Beginning balance of the owner's equity, which is the capital at the beginning of the period, plus net income, plus additional investments, if any, minus withdrawals. That will give us the ending balance of owner's equity. You remember that? We talked about in the previous recordings. So we can remove the net income, the income statement, and say beginning balance plus revenues minus expenses plus additional investment, if any, minus withdrawals. That will give us the ending balance. So revenues increase the owner's equity, expenses decrease owner's equity. And if we have more revenues than expenses, then we have net income. If we have more expenses than revenues, then we will have a net loss. Okay. I didn't have coffee today so far, so I'm getting my coffee now. Please be patient with me. And there are some guidelines and principles and assumptions that accountants must practice or must observe while they do their adjustments. Number one is the periodicity, or let me just okay. The majority of companies present financial, and I'm reading from the PowerPoints. Okay, I have my other screen over here, and I'll take a sneak look at it also here. So the one assumption is continuity or going concern. When accountants practice accounting, uh, they are under the impression or they assume that the business will run and continue forever. Of course, that is not the case because lots of corporations and businesses go bankrupt. Uh, go bankrupt, yeah. So, but the accountants operate under the impression that the business will continue forever. This is the issue of continuity or going concern. Another issue that the accountants must be aware of is the periodicity. Periodicity, okay, is assumes states that well, I'm going to say periodicity. You cannot expect to continue to record transactions all the time. At some point of time, you have to check how you are doing. Every once in a while or every period, see where I'm going from, I say periodicity. Every period, every once in a while, you have to stop and check how you are doing. And so some businesses check or report, do their reporting every quarter, every 3 months, some every month, some 2 times a year, some one time a year. Okay, that's called periodicity. So some companies choose any 12 months as their fiscal year, from June to June. That's called fiscal year. But if you choose January to December, that is a calendar year for their reporting. So this also has to be determined. Okay, they have to determine the accounting period, how often to report. Okay, uh, so let me just mention a couple of ideas here for us that we need to be aware of when we talk about adjusting the accounts. Okay, there is the accrual accounting, two types of accounting that we must understand while we adjust the accounts: accrual basis accounting and cash basis accounting. Okay, accrual based accounting and cash based accounting. And that has to do, both of these methods have to do, when do we recognize revenue or expense? Okay, when do we recognize revenue or expense? Under the accrual accounting, we recognize revenues and expenses when they occur. When the transactions take place, at that moment, we recognize revenue or expense, regardless of the receipt of the cash. Okay. Um, uh, the cash basis accounting, you will recognize revenues and expenses after the receipt of the cash. Okay, after the receipt of the cash. All right, so that's the difference between the two accounting categories. Accrual accounting, we recognize revenues and expenses once the transaction occur, okay, regardless of the receipt of the cash. Cash basis accounting, we recognize revenue and expenses when the cash is received or paid. All right. I'm just giving you guys some highlights here, okay, for the chapter. You need to go into more details in the book, all right? Okay, now when do we recognize revenue? Remember, we said in accrual accounting, revenue is recognized when the transaction has occurred. According to the SEC, the Securities and Exchange Commission, revenue is recognized after four things happen. Number one, there is a persuasive evidence of an arrangement exists. That means, all right, we have agreement. Let's say if I am an accountant and I want to do a tax return for somebody, all right, that person came to me and we made the arrangement. I started doing the work. Okay, that means there is an evidence that I'm going to do the work. And number two, a product or service has been delivered. That means I did the tax return, all the form, 1040 or 1040A. I filled that up and we signed the return. Number three, the seller's price to the buyer is fixed or determinable. That means we know that there is if I do the easy form, it's a lot cheaper than 1040 or 1040A. And the more complicated the situation is, the more expensive the tax return, doing the tax return. So we already know the prices are already there and we know what they are. And the collectability for me as an accountant is reasonably assured. That person is definitely going to pay me if I do the tax return for him. So revenue is recognized after four things happen. There is the persuasive evidence of an arrangement exists. A product or service has been delivered. The seller's price to the buyer is fixed or determinable. Collectability is reasonably insured. So those are, and I'm just reading those from the PowerPoint. Same conditions exist for expenses. Okay, there is an agreement to purchase goods or service. The goods have been delivered or service has been rendered. A price has been determined, and the goods or service have been used to produce revenue. At that point, that means the expenses were recognized. Okay, let's see now. There are two forms of adjustments, guys. There are two forms of adjustments. There are deferrals and accruals. Okay, two types of adjustment: deferrals and accruals. Now, both of these also have to do with recognition of revenue and expense. Recognition means, guys, recordable. When do we record revenue and when do we record expenses? Okay. Deferrals, I'm just give you the my own words on that one. Deferrals, the postponement of recognition of revenue and expense. The postponement, you postpone, you collect the cash, but you don't recognize your revenue. Okay, so all the prepaids are examples of that. All the prepaids are examples of deferrals, such as prepaid rent, prepaid insurance, supplies, okay, depreciation. All right, those are all deferrals. Accruals, you recognize revenue and expense the moment the transaction took place. Okay, you immediately recognize revenue and expense once the work is done, once the service is delivered. Okay, at that point, regardless of the receipt of cash. Okay, so that's the difference between, and there are all kinds of accrual examples like rent expense, insurance expense, seller's expense, utilities expense. All of these are examples of accruals. Okay, let's do a. I'm going to do an example for you about deferrals. Okay, deferrals. We said I'm going to do the. I'm going to use my board, the one that you don't like. Okay, let me clean. Supplies is an example of deferrals. Now remember, deferrals, we said that we postpone the recognition of revenue and expenses until service is delivered or merchandise is used. Okay, I'm going to do it this way. Supplies. Let's say that Ali purchased supplies for $1,000. Okay, cash paid cash. Okay, Ali purchased supplies for $1,000 and paid cash for it. Okay, this is a transaction, guys. Remember we talked about the double entry system. For every transaction, there are two sides. One side at least with one debit and one side at least with one credit. And the debit side must equal the credit side. And remember also when we talk about analysis, analyzing the transactions, determining categories and specific accounts. So for this transaction, this is just a review, guys. Just a review. This is a transaction. The two parts are, okay, you give me, I'll give you a second. Tell me what the two parts, what is the debit and what's the credit? The two parts of this transaction. All right? Supplies is one and the cash is the other one. Okay, now supplies is an asset, cash is an asset. Now what happened to the supplies? Did it go up or down? We purchased it. It went up. When assets go up, remember we said we debit those. Cash is also an asset. The cash went, did it go up or down, the cash? Because we paid cash. The cash went down. Cash is an asset. When assets go down or used, they are credited. So I would have to debit supplies and credit cash. Okay, so I'm going to debit. Okay, debit supplies. I'm going to debit supply. Notice, and then I go halfway the debit line. I do the credit line over here. Credit. Okay, debit supplies for $1,000 and credit cash for $1,000. All right, I'm not interested in cash now since we are talking about adjustments. Okay, remember I'm doing an example of deferrals, the supplies, using the supplies. It's a prepaid. Remember we purchased the supplies, we haven't used them. As we use them, they become expenses. All right, if I want to do a T account for supplies, supplies, this, the left side is the debit, the right side is the credit. Now tell me, where is the supply should be, on the debit side or the credit side of the T account? Remember, we said the normal balance means where the account starts and increases. So in this case, supplies is an asset, and with increases is debited. Therefore, the supply, the $1,000 should be over here on the left side. Okay. Let's say after 2 months, I used worth of $300 of those supplies. Okay, I remember we said when assets are used, they become expenses. Okay, in this case, 300. I'm going to put down 300 on the credit side because the supplies went down. When they decreased, it's an asset. When assets decrease, they are credited. So the balance right now in cash is, which one is larger, the debit side or the credit side? The debit side by 700. That's the balance. That means we have $700 worth of supply that we still haven't used in our inventory. Okay. So we used $300 of those supplies, and therefore, what kind of journal entry we need to do? Adjusting entry for those $300 of worth of supply that we have used. We're going to debit supplies expense, and you tell me what we credit. I give you 3 seconds. 1, 2, 3. What do we credit? We credit supplies. Notice I'm putting this is the debit line, this is the credit line. The credit line starts right down the middle of the debit line. Credit supplies for 300. Okay, see, we debited supplies expense for 300 and we credited supplies for $300. Okay, this is an example of deferrals. All right, maybe in another way, can be done in another way. Let's say at the end of the month, the balance of supplies is $600. How much did I use? If the balance is $600, I started with 1,000 and the balance now is 600. That means I used worth of $400 of supplies. I do the same entry, supplies expense, debit, and credit supplies. Okay, this is an example of deferrals. Now, I'm going to do an example of accruals. Let me clean that. Okay, let me take a sip of coffee. All right, let's assume that Muhammad Amin, he is one member of the class, is working at a convenience store. Okay, he works 5 days: Monday, Tuesday, Wednesday, Thursday, and Friday. Okay, let's assume that he works 8 hours per day and $10 per hour. $10 per hour. Okay, let's assume that the convenience store where Muhammad works, okay, their 31st of the month ends on Wednesday. The 31st of the month ends on Wednesday. And this December happened to be their fiscal year or their accounting period. Okay, their accounting period. On the 30th December, they have to do their reporting. Remember, and it looks like here we have 1, 2, 3 days that belongs to the current accounting period. Therefore, we must reflect in the current accounting period 3 days work of wages expense. Okay, so this is 3 days. 3 days of wage expense, 8 times 3, 8 hours, 24 hours, 24 hours, $8 an hour, 24 times $10, sorry, times $10 an hour. That will give us $240. These $240 worth of wages expense, the convenience store that Muhammad works at must reflect in their current accounting period. So they have to do an adjusting entry. They have to debit. I'm talking about the convenience store that Muhammad works at. They have to debit wages expense and credit wages payable. All right. Notice I keep saying that. I always put first the debit line and then I put the credit line. The credit line starts halfway the debit line. Okay, credit wages payable. Wages, I know you can't read it, but that's what I'm saying. Wages payable. Debit wages expense, credit wages payable for $240. $240. All right, we debit wages expense, credit wages payable. All right, that's because the convenience store must include those 3 days in their current period. Therefore, they have to reflect it in their books. Okay, so on payday, he usually get paid on Friday. So we have 2 extra days, Thursday and Friday. So first, we have to get rid of the convenience store must get rid of the wages payable. So we're going to debit wages payable. And I know we're going to credit cash for the whole week. It's a payday. Credit cash. So it is 5 days times 5 days times 8. That's 40 hours. 40 hours times $10 an hour, $400. So the cash is going to be credited for 400 the whole week. But wages payable was 240, you remember? So we debit that. Why did we debit wages payable? Because it's a liability. When liability decrease, we debit it. When liability increase, we credit. You got to go back to those rules that I showed you. You got to know those. So we have 2 days worth of wages expense. So we debit wages expense for plus 400 minus 240, 160. Okay, 160. Okay, so that is, guys, an example of accruals. Okay, so another example, guys, of accrual. This is going back to depreciation is very important. Depreciation, I'm going back to deferrals now. Depreciation. What kind of assets that depreciate? What assets that depreciate? Those are long-term assets, physical long-term assets, plants, equipment, building, machines, trucks, shelves. Okay, all of those are depreciated. And guys, if you have machines at your business, You got to get the depreciation. You have to. If you don't, you cut yourself short. If you don't, because you pay more taxes. You forgetting a chunk of expenses. So you got to figure out the depreciation. So when I figure out the depreciation for the current period, we call it depreciation expense. Okay, we call it depreciation expense. But if I want to know what is the net value of, I have equipment, I bought it 5 years ago, and every year it depreciates with $500. Every year, $500. After 3 years, 500 times the 3, that's 1500. That means the machine has been depreciated 500 plus 500 plus 500. That's 1500. We call that accumulated depreciation. So the depreciation from the time we get the asset to the reporting date, that's called accumulated depreciation. But the depreciation for the current period is called depreciation expense. Okay, so if the depreciation for the current year is $500, I got to make a journal entry because we have to reflect that into the current accounting period. I would debit depreciation expense and credit what? The accumulated depreciation. Okay, these two accounts are always go together. Now, if you have a car and you want to sell that car, okay, you're not going to see. That's what you want to look at the book value of that car because you want to know whether you made a gain or loss. So you take the original price of the car minus all the depreciation. What do we call it? Accumulated depreciation. Give us the book value or carrying value. Now, if you sell that car below the book value, you made the loss. You had the loss. You're selling it at a loss, but you have to sell it at above the book value in order to make a gain on it. Okay. There is one more deferral that we mentioned previously in a previous recording. Unearned revenue. Unearned revenue. That's a deferral. You got the money in advance, but you didn't do the work yet. If I have a laundry business and some customer came and gave me a sack of clothes and gave me $500 and told me go do the work, I didn't earn that $500 yet until I clean the clothes. Okay, so that's called unearned revenue. It's a liability. It's a current liability. That's another example of deferrals. All right. Okay. There is also an example of accruals, accrued revenue. Accrued revenue. If I am an accountant and I have a friend or I know some people, I do fill up the tax return for them and they're going to pay me later. Okay. I have accrued revenue. For them, they have accrued expense. Yeah. I did the service, but I did not collect that's the opposite of unearned revenue. This is earned revenue. Okay. Accrued revenue. Okay. There is at the end of the accounting, after you record all your transactions in the general journal, and if you do your reporting quarterly every 3 months, okay, You have to do before you go to a directly to the financial statements. Remember, we said we got to post to the general ledger, from the general journal to the general ledger, and you will have. It's very, very important, very helpful to you to do a trial balance. To do a trial balance. A trial balance is a list of your accounts. I'm going to get the textbook and show you how the trial balance look like. Let's see. I have my books over here. All right. This is the accounting book. Okay. This is our accounting book. Okay. And this is the ISBN number, as you can see on the bottom right here, the ISBN number. Okay, let me go to chapter 3. I want to show you how a trial balance looks like. I better go to the review example where you can practice that yourself. Okay, on page 105, there is a good example of trial balance. It's a list of all your accounts with debit and credit columns only. Okay, page 105, a trial balance. You see, this is a trial balance. Okay, you have the title here, the name of the business, trial balance, and the date, and 2 columns only. 1 column for a debit column and a credit column. Now, where did we get these numbers from? These are the balances of the accounts from the general ledger, the ending balance of each account. The ending balance of each account. That's where you get these numbers from. Or if you did T accounts, that's the ending balance of each T account. The ending balance of cash, the ending balance of account receivable, the ending balance of inventory, and like that. Those where they come from. Okay, and always, like we said, the assets should always come on the debit side. Assets, remember, assets, expenses, and withdrawals are treated the same way. The normal balance should always be on the debit side. Liabilities, revenues, and the capital, normal balance should always be on the credit side, on this side. Okay, those numbers came from the ending balances of each account from the general ledger. We'll talk more about that. And also remember those adjusting interest, guys, that we talked about, the adjusting interest that we just mentioned earlier, they are going to affect these accounts. They are going to increase or decrease these accounts, the adjusting entry. That's why you also have to do adjusted trial balance. You have to do adjusted. That means you reflect revenues and expenses. You reflect the changes that were made because of the adjusting entries to those. All right, we'll talk more about those in chapter 4 in more details. Okay, I do believe that is all what I have for you for chapter 3, guys. Like I said, you have to read the book, it gives you a thorough and detailed analysis. All right, I'm just giving you a highlights or some terminology, some explanations. Okay, that's by no means uh, every details of the chapter. Okay, I just gave you the major highlights of the chapter, and that is not enough. Now remember, as I told you, chapters 1 through 4, you have to read those word by word because you are building your accounting knowledge. These are just like if you build a house, you have to have a split. I hope I'm saying it correctly. You have to have a split. And so the first 4 chapters are the split for understanding account. That's the base. So you have to read it word by word, the first 4 chapters. Do it example by example. If you don't have the book, you are wasting your time. Believe me. I know. I know how I studied accounting and what it takes for accounting. It takes patience. Okay, it takes patience, it takes time. Okay, but at the end, it's a very rewarding career. If you become an accountant, it is a very rewarding career. You just need to be patient and understand the basics. Now, whether you become an accountant or not, accounting is the language of business. Imagine you are the CEO, like I mentioned before, or you are promoted to a division manager. Somebody did adjusting entries and you don't know about. They made the books look okay, and you don't know how to do a journal entry, or you don't know how to read the financial statements. Whoa, you are in trouble, yeah. If you don't, so that's why the language accounting is the language of business. Regardless, even some other disciplines are now trying to understand accounting. In any discipline, in any area, if you become a manager in that area, you got to know how to read the financial statements, how the business is run. It's very, very important. Whether you are in medicine, whether you are in law or in business, wherever you are, if you are the manager, you need to know how to read the books. Okay? That's all, guys. Have a good Friday. All right, let me get in this stream. End. Okay.